Today's webinar is on a topic I've been interested in organizing for a while. Well, obviously, since interest rates went up. I've been around in this business long enough to remember the last time business interest rates were up. And in fact, my own mortgage on my first home was in order to reduce the interest rate to something manageable, I got a 7-year balloon at 8 3/4. So I'm sure some of you can age me by that right there. But I also have this vague memory. I'm aware that mortgage interest rates in like mid 85, I think got as high as 14 3/4 or something like that. So I'm sure nobody wants to hear me say things could be worse. Yeah, there's a little shock. But things are getting better. Nonetheless, it's quite a different market than we have had for a few years, and it's really knocked so many people out of having the buying power to buy their first home. It's also locked in a lot of people who have lower rate mortgages to a point where they don't want to sell their home, so it's really locked up the market. I actually talked to a colleague of mine that said in Europe there is such a thing as a portable mortgage, which I think is a great idea. So you can take your financing and move it to another property, assuming all the other things check out. But we don't have that here. What we do have, though, is the opportunity to buy down interest rates. And that's what we're going to talk about today. We have 3 wonderful panelists who've really dug into this issue and found the funding and created the scenarios where they've increased people's buying power substantially by simply buying down interest rate. And the effect of that is really stunning. So as Anne, my colleague, is telling me to go ahead and do, let's check out where you guys are from in terms of what sector. We like to know who we're serving with our topics, who's interested in what topic. Generally speaking, we tend to have at least half nonprofits and growing local government audience. And then we always have a nice mix of state and federal agencies, intermediaries, and other consultants like me. Oh, and Eric Lee's from First National Bank. So sometimes we get financial institutions. So welcome, Eric. So that pans out about as typical. Okay. You want to share the results, Anne, or have we all seen that? I'll click the share the results button. So I'm going to move that over, and let's just give you the 1 or 2 slide background on Middle Neighborhoods if you don't already know what the Middle Neighborhoods Initiative is or what Middle Neighborhoods are. Middle Neighborhoods Initiative is focused on mobilizing attention to reverse the disappearance of middle neighborhoods, which is happening across America, either through decline or gentrification, depending on how the national and regional housing markets are operating. There really is a disappearance of these. And of course, it kind of mirrors also the disappearance of the middle class in general. We have at the initiative a community of practice, which is the group that I'm one of the organizers for and which sponsors this webinar series. The initiative is co-organized by NeighborWorks America and NCST, National Community Stabilization Trust. And so between those 2 organizations, they also do research, policy analysis, and a bunch of communication strategies. I think we have one more slide about what middle neighborhoods are. Yeah, so generally speaking, they tend to be places that were mostly built with single-family homes because they were built at a time when the idea was families with children, which is nationally a declining demographic, although not in certain markets. And it's part of the reason why, consumer preferences have changed and why, in some cases, middle neighborhoods aren't the first place where new home buyers are looking. They tend to be still well more than 50% owner occupied, but that can be slowly eroding over time. And it's definitely something that caused a lot of people, the organizers of the Middle Neighborhood Initiative, to take notice is, wow, if we look at these neighborhoods over a long period of time, they're really on a downward trend. The housing stock is aging. It's still in better condition than more distressed neighborhoods, but it often lacks the features or updates that would help it compete well for today's home buyers. So maybe there's a lot of housing stock in some places that only has one bathroom, which can be a death knell in terms of having an owner occupant buyer choose it. There may just be, updates to kitchens and baths that need to happen and just haven't. So that is a topic that takes up the bandwidth of a lot of middle neighborhood practitioners. They do tend to be more racially, ethnically, and economically diverse, which is very interesting. I think middle neighborhoods are those mixed income communities that most of us in community development are always trying to create or maintain. Some cities don't use the language middle neighborhoods, but they talk about workforce housing or missing middle housing and the neighborhoods where those things occur. So a couple of things we want to remind you of. We do have a mapping function at our website, which will allow you to take a first cursory look at what census tracts in your MSA might match with some different income ranges, which are running on the left side of the screen, and you can toggle amongst them. And it's really just a starting place, but it can give you a sense of, if I'm comparing myself to a city median or a regional median or a national median, what census tracts line up with that. And I think our next slide is about LinkedIn. It is. We're really trying to build up our LinkedIn following so that we can do more communication there. So if you are a LinkedIn person, we'd love it if you could follow us. And now, finally, to our panelists. So we have today Candy Ayers, who's Director of Homeownership Services at the Community Action Program of North Alabama, or CAPNA. And Candy's one of the first people that kind of brought up to me that she is a former lender, as you'll hear, and she realized that if she wasn't able to do something about interest rates, she wasn't going to be able to get her homebuyer customers into a home. So she, knowing the power of an interest rate buy down, set about trying to see if she could make that happen. Elliot Schmeidel is Director of Homeownership at Massachusetts Housing Partnership, and he is one of the people who is responsible for having created and continues to manage the One Plus Boston Homebuyer Program, which is a really very large and high impact interest rate buy down program. It's really interesting. And if you ever have a chance to look at their website, they have amazing charts that show just how much the buying power changes with adjustments in interest rate. And then we're going to go off on a little bit of a different take on this topic. And Rachel Mulberry, who's Director of Policy and Strategic Initiatives at the Philly Housing Development Corporation, that is the nonprofit arm of the planning department, I believe. They have a program that has bought down interest rate for funds intended to go to loans to existing homeowners for home repairs and improvements. And it's called a Restore, Repair, Renew program. And it was really designed to address a lot of middle neighborhoods with homeowners who needed work done on their houses and needed some help doing it. So I thought that would be a really interesting additional viewpoint. So I think we're going to start with Candy. That's such a beautiful slide. And so welcome, Candy, again. This is the second time in a couple of months, I think, that Candy's joined us. And take it away, Candy. Oh, by the way, you'll all get a copy. We'll all have a link to the slide deck. And we're going to hold questions to the end. Thank you.
Hi, I'm trying to keep the slides to a minimum and cover as much as I can, as quick as I can. I am Candy Ayers. I'm the Director of Homeownership with Community Action Partnership of North Alabama, and we are very lucky to have some great partners. So one of our partnerships that we have is with the City of Decatur. We do a single family community with them, and they have been doing some subsidies to help get some people in those homes there. But what we have discovered is the affordable housing is just gone or out of reach for most people. And COVID just kind of stopped the world. We all know that. There were job losses. Many lost their homes, although there was stops put in place to keep that from happening. It still happened. And then that gave people, you want to go to the next one, gave people basically that were renting, they either needed help for rent, which we were lucky enough to get a lot of different sources. United Way, the city of Decatur gave us funds to help keep people housed, much more than we've ever had as an agency, which was fabulous. However, there were still evictions that got filed. And then after rent started doubling, it's crazy. Things that were in our area $550 are now $1,200. They're just priced out of the market. Apartment complexes got sold to investors all around the country. It's very hard. We're a small area here, and places had been owned by local people for a long time. And now when you try to find somebody, they're Florida, California, just all across the country. And then so what we're hearing is rent is as high as actual mortgages. And we all know that that has happened in the past, but around here, it hasn't been that way. And so it's something new for us. So flipping to the homeownership side, which is why I'm here, all of the housing prices just soared. It's just crazy. In my world, I was in the mortgage world for a long time, and I sadly foresee things that we all know foreclosures happen when you put people in houses that they can't really afford, start pushing those mortgage rates. So with these bigger home prices, it's harder to get people qualified. Property taxes follow the market. So property taxes go up, insurance goes up. All of those affect the down or the, the bottom line of what the customer is going to pay every month. So trying to fix that issue. We also know that because people lost their jobs, those that weren't able to hang on to them with companies closing, they ended up having some income gaps, which makes it harder to explain. COVID is the best reason out there, but lenders sometimes, if you don't have that solid 2 years, or you were making a decent living and went through all your savings and lost your job, and then now you had to take a lower wage, it's made it even harder for people to purchase. So moving forward, an opportunity that I saw was we were struggling to have homeowners. We were closing, we're a small area, but we were closing at least 30 homes a month. We do homebuyer education. We have people in the pipeline. And so we averaged at least 30 sales a year through our homebuyer education program. But what was happening was we weren't able to get sales to report to, we're a NeighborWorks organization. We're also a HUD approved housing counseling agency and HUD counselors. So the city called and said, hey, we have a lot of money and we can't get rid of it. How can we save people some money and help get them into houses? And I said, well, that's funny. We had just talked about that a few weeks ago. So let's talk about some ideas. So in the past, the city of Decatur has a Decatur Home Program, which is their down payment assistance program. And they put 0.5% towards down payment, or they would pay all of your closing costs. So not 0.5%, but half of the down payment they would pay, all the closing costs and including the prepaids up to $4,500. So they said, can we throw a little bit more money at it and buy down just the loan amount? Let's just lower the loan amount by, I don't know, $5,000 or something. And I was like, give me a little while to think, because I wanted to present it to them properly. I said, let me call you back tomorrow. Let me jot down some ideas and let's go into it further. So what I came back with was, in the past, when interest rates were high, we used to buy down rates. So why don't we go ahead and try that, which was something that they weren't familiar with and hadn't done before. But it just so happened next year is the consolidated plan. So I had worked with some HUD contractors or CDBG contractors that the city had hired. I had worked with them on some rental assistance follow-up and knew one of them, and they called and said, hey, we're coming to help the city with a consolidated plan. Do you have time to meet with us and tell us about the needs? And so we met on Juneteenth, and I said, okay, so here's what I want to do. And so I said, I know the city wants to put in some money, and we talked about $15,000. I don't want to use it to lower the loan amount. I think we should buy down interest rates. And the one guy's like, oh my gosh, that's a great idea. I think that's wonderful. Yes, let's try that. So, being the HUD gurus they are, they made sure that everything would work through HUD, that they weren't violating anything. And we talked with the city. They went and presented and met lots of other places as well. The council, the chamber, they met with United Way to make sure that everyone was saying the same thing I'm saying, is we can't create home buyers because they can't afford the new payments. And we're a community action agency, so we work with low to moderate income families. We do build apartment complexes and things of that. We try to keep rent down. We want to create workforce housing, not just the stigma of affordable housing. We want to turn it and make it workforce housing. This allows people to purchase homes under a workforce price. So their mortgage payments are not too high. Sadly, we just started the program, so I've only had one so far that's closed with the city using the 15,000. And in that case, their first lock that they wanted to lock on the loan was going to give them a 6.25% rate. And so that was put on hold for a little bit, knowing that this program was rolling out. And so the lender allowed them to buy down the rate to 5.75, and it cost 1.918% to do that. So it saved the client $63 a month, but over the life of the loan, it's going to be $22,320 savings. So you would say, well, $63 isn't a whole lot, but when you're pushing ratios, $63 a month actually does help. So I'm hoping to see some bigger opportunities. A lot of this money was sent, they still use the 15,000. They paid some closing costs. They paid prepaids. The client ended up getting like $300 back out of the money they put in for the appraisal. So out of pocket was nothing. The city covered everything, and we have a new homeowner. So
Andy,
I know
can I ask what was the sales price of that home in that example?
200,000.
Okay, thanks. Just to give people an idea of the market. Yeah.
Okay, that wraps it up for me.
Okay, well, that's a great. Now, one of the things I really think is valuable here is Candy has an example where most organizations that are nonprofits that do homeownership services could probably pull this off in the next year if they had a willing local government that was providing them with their down payment and closing cost money anyway. So she didn't have to get as complicated as we're about to get with Elliot, who's invested years and years and years in creating a pool of conventional lenders that already work together and trust him on another product, but I'm sure he's going to tell us all about that. So let's go from the easily accessible that Candy gave us to what you can do when you're really all about it with Elliot. So take it away, Elliot.
Thank you so much, Marcia. Hi, everybody. My name is Elliot Schmiedel. I'm the Director of Homeownership at MHP, or the Massachusetts Housing Partnership. So I'm just going to start off by sort of framing this, talk about us as an organization a little bit, and then our core mortgage program, which to Marcia's point, we've been operating for over 30 years, and then focus the back part of the presentation more specifically on our 1+ programming that revolves around the structured interest rate discount. So back to who we are, we're MHP, we're a quasi-public state agency. We've been around for well over 30 years at this point, and our goals really revolve around a few different things. Increasing the supply of affordable housing in the state of Massachusetts is numero uno. We really focus on households below 100% and below 80% AMI. We promote racial equity. We long realized that home ownership among Black and Latino and borrowers of color lags well behind that of white counterparts. In Massachusetts, I think in recent years and decades, we've had actually one of the widest gaps in the whole country. So it's been a real focus of ours lately to create programming that can help close the racial homeownership gap. Next slide talks a little bit about how MHP goes about its work. In addition to the homeownership team, which I run, we've got the community assistance team. The community assistance team is really there to partner with local cities and towns. They work with planners, housing, officials, planning boards, zoning boards, et cetera, to help provide information and insight, but really change the narrative. There's a lot of NIMBYism, if you will, in the greater Boston area and across Massachusetts that prevents housing from being built. And our community assistance team are experts in how to discuss affordable housing within the right context and hopefully, change the hearts and minds and lay the groundwork for our rental financing team, which is comprised of loan officers and underwriters and relationship managers who work with for-profit and nonprofit developers to produce rental housing. Anything from small infill type, half a dozen units to several hundred unit apartment buildings within, urban areas, suburban areas, rural areas in Massachusetts. So we're all over the state. We have a Center for Housing Data, a team that is really focused on providing people who are in the affordable housing world in Massachusetts with the data they need to make informed decisions. They've created a number of tools, as I've listed here, called Data Town, Todex, Residensity. They do policy briefs and research papers and research products, and have really helped take our work to the next level at MHP. And then we're rounded out by the homeownership team. That's what I'm here to represent today. For over 30 years, we've worked with banks and credit unions across the state to partner with them to use public funds to leverage private funds. Our focus is on first-time home buyers under 100% area median income. We help banks and credit unions fulfill CRA requirements by creating innovative products and programming that they can offer their clients. So that's a little bit about MHP. That's how we do our work. One Mortgage is our flagship homeownership program. One Mortgage had a predecessor called Soft Second, but the two combined have been operating since 1991. We've helped over 25,000 home buyers. If you go way back to its creation, just tell a quick little historical story here. In 1989, there was a report published by the Boston Federal Reserve, the Federal Reserve Bank of Boston, highlighting mortgage discrimination based on race within the Boston area by a number of different lenders, modern day redlining, if you will. That report was leaked to the press. There was a front page story in the Boston Globe, and the fallout was banks, community officials, nonprofits coming together saying we need to create a product that can help meet the needs of buyers of color and low to moderate income buyers. And that's what the Soft Second program was the result of that. In 2014, we changed the name and the structure to One Mortgage. And that's what I'll go through here. And I'm setting the table for the interest rate discount piece because it all revolves around this core product here. It is nice to have something in place that lenders are used to and can sort of build off of rather than going back to the drawing board and starting from scratch. So One Mortgage starts off with a low fixed interest rate. We require banks to actually offer our core piece of programming with a 30 basis point discount. So right off the bat, and we're not paying for that. That is an agreed upon term of the program. If you take the Freddie Mac rate, which this week or last week was 6.2%, our lenders need to offer One Mortgage at 5.9 or below. So the borrower benefits right there. And we all know the power of interest rate deduction. It's gonna save significant amount of money, not just in the short term, but over the life of the loan. The down payment minimum is 3%. Borrowers need to bring 1.5% of their own sourced seasoned funds to the table. They can then match that with 1.5%, gift funds, down payment assistance funds, And as I'll talk about in a few slides, our program is commonly paired with a number of different assistance programs offered throughout the state by different entities. There's no private mortgage insurance. That's another huge savings. If most buyers putting down 3%, 4%, 5%, which is kind of the average, would have to pay private mortgage insurance with most other products, and that's going to cost several $100s a month. But we use public funds instead of paying for private mortgage insurance to create a loan loss reserve pool that we hold at MHP. And then it's a loss share pool if a lender experiences a loss on a one mortgage as a result of a short sale, a foreclosure, or bankruptcy. They will file a claim on their reserve, and MHP would pay up to 80% of that qualifying claim. So that's a great example right there, just the loan loss reserve of using public funds to help mitigate risk and leverage a much larger amount of dollars from the private sector. Lastly, we have some state subsidy available. This has been a pillar of the program for over 30 years. Borrowers below 80% AMI are eligible for interest subsidy. This is separate from rate reduction, which I'll get into. This is interest subsidy. It's going to help essentially lower the effective interest rate. The note rate doesn't change, but we are subsidizing their interest rate for a period of 7 years. It's designed to help a first-time home buyer who just barely qualifies sort of ease into that full payment. The full payment PITI will hit in year 7, but between years 0 and 7, we want to, sort of gradually wean them off that subsidy. And so that's how that works. Talk a bit about eligibility. I think that's important in framing, any of these conversations. We are a first-time home buyer program. We define that as folks who have not owned in the previous 3 years. That includes, and what's really unique about our program is that it includes not just the borrower, that's every adult in the household. We really, really want to target this program to the folks who need it most. And so our lenders actually collect income and asset information, including tax returns for all adults over the age of 18 in the household. And we ask them to look for evidence of mortgage interest deduction or property tax deductions to help determine whether or not they are a first-time home buyer. Home buyer education, huge component of the program as well. We have a really robust network of home buyer education organizations in Massachusetts. We've got over, I think, 40 qualified, established nonprofit homebuyer education providers throughout the state that we work with who hold classes very regularly, educate folks on not just our program, but other affordable programs that are available. And everybody who gets a one mortgage needs to complete that class. As I mentioned earlier, we're an income-based program as well. Our income limits are 100% area median income, as determined by community that they're going to purchase in and household size, of course. And then the asset test, we have an asset test that limits the program to folks with less than $75,000 in liquid assets. It does not include retirement funds. You can still have money in a 401k or 403b or an IRA. But we're really looking to help folks who, if you have more than $75,000 in liquid assets, the idea is you're going to have a lot more success obtaining a traditional mortgage than somebody who has less than that. So that's a little bit about borrower eligibility. I mentioned that the program pairs well with other products, and that has become, it's always been important, but like amplified many degrees over the past several years. I think that home prices in Massachusetts have risen 30 to 40% since 2019. Might be 40%, to be honest. The pandemic was just like, gasoline on a fire. And luckily, we have a lot of assistance programs in Massachusetts. We've got cities and towns who administer, of course, home funds and CDBG funds. A lot more cities and towns these days have CPA, or what we call Community Preservation Act funds in Massachusetts. The Federal Home Loan Bank of Boston offers some great programming, really targeted towards the exact same, income bracket of first-time home buyers that we work with. We work with nonprofits like the Mass Affordable Housing Alliance, or MAHA, who offers a program called Stash. It's a sophisticated matched savings program for first-generation home buyers. We've got folks coming out of the Section 8 program who use their Section 8 voucher and pair it with a one mortgage or their family self-sufficiency savings. And we did our first loan recently on a Habitat for Humanity home, which was really cool. So I think the idea here that I'm trying to get across, not just about our product, but about first-time homebuyer needs in general, really trying to create things that work together and can be paired and layered. And that's what we've tried to do. This is just a summary of our lending in 2023. And if I could show you previous years, what you'd see is that this is actually a low number. You know, our volume had come down. The market's been really tight. Inventory is low, prices are high, and interest rates have been high. But we've traditionally been on a track where we do about 800 to 900 loans a year. As I mentioned, we're very focused on low to moderate income, and proud of the fact that over half of our borrowers were actually below 80. So, you know, borrowers below 80 in Massachusetts purchasing their first home, that's a huge victory for those folks, because prices here, I think the average price in the state of Massachusetts is over $500,000. In the greater Boston area, it's, you know, north of 750, 800. So the program's built-in affordability features go a long way. We've also served in the past year, or in 2023, 70% of our home buyers have identified as non-white. That's, I think, in large part, and our program is not designed explicitly. It's not a race conscious program. It's a program that is advertised and talked about, and awareness is spread through the community, through homebuyer organizations, through partner lenders. And I think there's just there's a strong focus on gateway cities. Gateway cities in Massachusetts are sort of older, industrial, mill cities, and the city of Boston as well. And as we talk about the city of Boston, that's where I'll pivot to talk about rate discounts, as we've created them under the One Plus Boston program. So it's one thing to talk about the state being expensive, but it's different to talk about Boston itself. It's one of the most expensive markets in the country. And it's become, you know, very difficult for first-time homebuyers to get their foot in the door. The city does do a great job using public subsidies to produce affordable deed-restricted units, but for every one unit, there's a list of 200 qualified buyers waiting in a lottery. And so we've got to try to close the gap between what your low to moderate income borrower can afford and the market. And that gap required us to investigate permanent interest rate buydowns, because it's going to help lower their qualifying ratios and stretch their dollar in a way that allows them to get into the market. We looked at some research by the Urban Institute. Shout out to the Urban Institute. Amazing research and policy briefs and white papers on all this sort of stuff that we're talking about. We crunched some numbers, and if you take, you know, for instance, say $50,000 or any amount of money, the benefit that you get in terms of savings and affordability, when you take that money and you apply it to interest rate discounts or buydowns, is much greater than if you just put it on down payment, pay for down payment assistance. It's going to help make that home more affordable to that borrower over the long run. And it's a great way to, you know, as our program is as a whole, to use public funds to help leverage private funds. And that's really what we're all about. Long-term partnership with banks, creating programs that are, you know, really good for the state, good for the buyers, good for the lenders. So I'll talk more specifically in the next slide about what this program looks like. We partnered in late 2019, early 2020. We were supposed to launch this program in like June 2020. So it's like we were a little late starting there because there were a few other things going on at the time. I think we got rolling later that summer. The city of Boston was able to secure those CPA, or Community Preservation Act funds that I mentioned earlier, as well as lately some ARPA funds that we funneled into this program. So first thing, city municipal buy-in, right? And we decided to offer 2 interest rate discount levels based on income. The first level is a 100 basis point discount from our base rate for borrowers below between 80 and 100% area median income. And we got to pay for this. We pay the bank 4% of the loan amount for that 100 basis point discount. That's sort of the standard. The second level is a huge discount, 200 basis points for borrowers under 80% AMI, and we pay a discount payment of 8% of the loan amount. Those funds are paid for, the money comes from the city to MHP, and then as the loans close, MHP is providing that rate discount payment to the lender the day of closing. We do have a structured clawback period. We want to try to mitigate against property flipping, receiving a large amount of subsidy and flipping the property. So there is a clawback period where we can get some of the money back within a 24-month period if folks do sell the property. It's funny that we're here today and in the past 2 years talking about this program in the context of high rates. But when we created this program in 2020, we saw rates plummet, and we got to a point where we were making loans in the ones. We have borrowers with 1.875 30-year fixed rate, and it's amazing. But the lenders kind of said, whoa, we got to put a floor in here. It's hard to do business with too many loans on the books in the ones. And so we instituted a rate floor at 2%. I hope we get there again. I want to offer as many benefits to first-time home buyers as possible. And today, if you were to take these rate discounts, you're looking at rates generally between 4% and 5%. So I think that's a very comfortable place for pretty much everybody, lenders, buyers. $75,000 maximum assistance per household. That might strike some folks from other parts of the country as a whole lot of money per household. And it is. The program in Boston started with 50. And after a few years, we actually bumped to 75. And, there's a chance we could pull back. It's really about how impactful the program is, how many folks we're reaching, and how much funding we have secured for this program. We got to find that right balance between helping as many people as we can, but helping them with the right level, with enough assistance to help them access the market.
Elliot, do you know what the median price is of a home in your program for this interest rate buy down?
It's in the 4s. Yeah. And I'll tell you why it's in the 4s, because we finance a lot of affordable deed restricted units. The market rate properties are probably in the 6s, but that they're then pulled down. The weighted average would be pulled down by an outsized share of properties in the 3s that have, long-term deed restrictions where equity accumulation is going to be limited, but still offer a great opportunity for folks to buy their first home. So in 2023, what's interesting is I never saw this One Plus Boston program becoming such a large share of our overall programming, but it was nearly a third of all of our loans in 2023. 67% of the One Plus Boston loans went to households under 80% AMI, and again, nearly 70% were BIPOC households. And Boston is a majority minority city. So we're really trying to serve, the population according to, how it's constituted. And I'll just talk a little bit about looking ahead. We just launched another program this week, actually, sort of a low fanfare, small pilot program with another city in Massachusetts. The city is called Lowell. The program is called One Plus Lowell. It's up north, about 30 miles north of Boston. And they were able to secure some of their own Community Preservation Act, CPA funding. And we took a similar approach, but we only included one level of interest rate discount and actually a maximum of $30,000, not 50. The prices in Lowell are not what they are in Boston, so we don't necessarily need it to pump as much money into it. But we're hoping to help about 20 households with this small pilot program, see how it works, see if we can secure more funding, and go from there. And then the big thing, which I really don't have any detail on, but wanted to share, is that we're working on a broader program called One Plus MA. One Plus Boston has been so successful that we and the state and our lending partners really want bring the benefits to a broader geography, help more folks who want to buy across the state. So we are spinning that up as we speak, and hope to launch something later this year in late fall of 2024. So stay tuned. There will be information on the website soon enough. But I think it's almost like we're realizing it's a new day in terms of how our programming is structured. For 30 years, our traditional program was getting the job done, meeting the market, closing that gap, and the gap has widened at such an accelerated pace over the past few years that the way I see it today, these interest rate buy downs from as we offer them are here to stay. As long as we can continue to secure funding to pay for them, they're almost going to become the new norm for low to moderate income first-time home buyers through our programs. So
That's really interesting.
Yeah, about it for me. There's my contact information. Love to hear from folks if they have questions or want to discuss any of what I shared.
Elliot, I did want to ask, I pulled it up so I can share my screen
Oh, sure.
if Anne lets me. Yeah, she will. I
No.
wanted you to walk us through that great chart.
The one that I forgot to put in my presentation.
Yeah,
Yeah.
that one.
Yeah. Yeah, this is a chart that shows the increased buying power of a 1+ Boston mortgage versus a 1 versus a conventional. So what we're doing here is holding the borrower's income constant, and I don't have off the top of my head what that income is. And we're holding their qualifying ratios constant. And a borrower with this income trying to qualify for a conventional mortgage could afford $450,000 home. If they use our traditional product, their purchasing power goes up by almost $100,000. But if they use 1+ Boston, it's up about $150,000. You're benefiting, as you can see, from a lower interest rate, the lack of private mortgage insurance, and the MHP interest subsidy that I mentioned. So, those things, what's one complicating thing about that? It's that borrower would end up with maybe 3 mortgages. They'd have a first mortgage from the lender, a second mortgage for the interest subsidy, and a third mortgage, or maybe a grant, depending on how the program's structured for the down payment assistance and the 1+ features. But
That's
it's all
stunning.
worth it in the end. And, we try to put our heads together with our partners to come up with recapture terms that work, that keep in mind 2 things, really: the financial sustainability of the program, because it's nice to recapture some money over time, to use it again for new buyers. But it's also nice for people to be able to retain as much equity as they can. We want to help folks build. So there's a balance there, but I think that the purchasing power differences are striking, and really, at the end of the day, mean the difference between, like, you can either afford the market or you can't. And what we don't want, is for folks to leave Massachusetts because they can't afford it. We have great, academic educational systems here and job markets, and we want to keep people. So we need products and financing products, and we need homes ultimately as well. So,
And that's only the first level of your program. You also, depending on income, could do 2%, right? That could end up being
correct. I mean, that's a good point. Off the top of my head, oh, right, this is only the 100 basis point discount. So this doesn't even include the 200 basis point discount, which written into our guidelines is a temporary, though that temporary has been going on for about 1.5 years now. And it's kind of a matter of how much money do we have and how long can we continue to offer the big discount. Come the end of this year, it's time for us to reevaluate that. So,
but that must, I mean, I can't even imagine what that buying power number would be, or how much it would reduce the monthly payment. If another
50 probably in terms of purchase price. Yeah, for sure.
And then the other thing, let's see. I lost it. Okay. Oh, probably over the life of the loan, the difference in what that person's paying.
Huge.
Yeah, huge.
Yeah, and the way I like to lay that out is, we're talking about folks under 100%, in a lot of cases under 80% median income, families, households of 4 or 5 people. the money they save on their mortgage can be used for other things, saving for college, buying a car for the
Right.
16-year-old, putting gas in the car,
Getting the
buying
car
all
insurance
that
on
stuff.
that 16-year-old's.
Childcare, don't even get me started on the childcare costs in Greater Boston are more
Oh,
than a lot of people's mortgage payments. So it's well served going to other places.
that's great. That's really a stunning difference, Elliot. So thanks for that. So now let's hear from Rachel about how she's used this principle in Philadelphia to help people with home repair and improvement loans. And maybe as part of that, Rachel, you can sort of share with us like what so-called normal home equity loan would be, interest rate would be nowadays. I can't quite, I'm just not up on that information if they weren't using this program. So everybody, Rachel Mulberry.
Thanks so much for having me and allowing us this little detour away from
Home
home purchasing to talk about how in Philadelphia we're supporting residents who are homeowners to keep their homes, keep accruing the like kind of equity in the home and just the use value, right? So I'm going to talk today about Restore, Repair, Renew. It was originally christened the Philadelphia Neighborhood Home Preservation Loan Program, but that was such a mouthful that everybody just calls it by the kind of tagline, Restore, Repair, Renew. I do want to mention that Philadelphia has a $10,000 grant for down payment assistance and is doing other kind of creative subsidies for new construction on land coming out of our land bank. So we are trying some different things in the home purchasing space, but again, today I'm going to talk about the repair piece. So we can go back one slide. Yeah, here we go. So the kind of why of this. So some of the data here is a little bit old, but I don't think that it's changed from what I've heard from my colleagues at the Fed. So when they looked back in 2015 to 2017, they were seeing really high denial rates. And again, this is not unique to Philadelphia, but for homeowners who were looking to get home improvement loans, they were being denied, well over half the time. And when we look at low and moderate income homeowners, especially non-white applicants in majority minority neighborhoods, we were seeing denial rates, well over 70%. And Philadelphia has some of the oldest housing stock in the country, although I'm sure Elliot and Boston could, we could debate whose housing stock is older, but our older row houses need a lot of work. And so these denial rates were meaning that people were being shut out of the opportunities to do both the kind of health and safety repairs that were needed, as well as some of the upgrades, that everybody wants after 30 years with the same kitchen. And so that's really the why for the desire to create this program. If we can go to the next slide. So Restore, Repair, Renew is a City of Philadelphia initiative. It's funded with a municipal bond. And it offers a 10-year 3% fixed interest home repair loan up to $50,000 to eligible homeowners. And again, it can fund a wide range of repairs. So we're looking both at things, code violations. Oh, can you go back slide? Yeah. As well as any other sort of improvements that homeowners are looking to make. And again, the reason that it came to be, we're really lucky in Philly to have a very robust and large home repair grant program. But because of the demand and the kind of income profile of folks who qualify for that grant, there's a number of households who earn too much. And the city doesn't have currently the kind of financial capacity to expand that grant program to higher earning households. And so there was really a need to serve those who were getting shut out of the grant programs, but again, were getting denied by traditional lenders when they went for some sort of home equity product. And Restore, Repair, Renew, the last piece I'll say is that it's administered by the Philadelphia Housing Development Corporation, or PHDC, where I work, but it's done in partnership with a number of really valuable local partners. We have Clarify, who's a financial services entity that and housing counselor that does the intake for the program. Then we have a couple of regional lenders that do the origination and servicing, and I'll talk more about that. But you know, I'm here today on the call, but again, this program really works because there's others at the table as well. We can go to the next slide. And really the key piece here, again, we have that fixed interest rate at 3%, which is possible because of that funding from the city. But the other thing that's different here is that rather than the full, you know, very complicated set of criteria that a traditional lender might use to underwrite, we are looking at a very simple set of manual underwriting criteria. The first is a little bit different, which is that this is an income restricted program for families earning at or under 120% of the area median income, and in Philly that's around $137,000 for a family of 4. So it's well above the cutoff for our grant programs, and really does serve a wide swath of homeowners in Philly. But then for the real underwriting criteria, so we've, by bringing this funding to the table, been able to work with lenders who are looking at minimum credit scores of 580. So that's really a big change. The GTI is nothing radical here, 43%, and the loan to value is 105 of the post rehab value. And what that means is that this product works quite well for people who have been in their homes for some time and seen that value appreciate. It does not work as well for people who purchased a home in the last year or two and haven't built much equity. Unfortunately, it's not a silver bullet. This particular product doesn't work as well for them. We do require homeowners insurance, which is occasionally a barrier, and it's a challenge I'll talk a little bit more about, as well as clear title. And in general, we're taking up the second position, although we are flexible if, you know, with any sort of soft second for down payment assistance or other kind of foreclosure mitigation mortgages that might be in second position, we're happy to take third there. We can go to the next slide. So it's grown over time. Restore Repair New started out relatively small, and we've streamlined things and built up capacity. So at this point, we're nearing our 500th loan, and again, the program started just about 5 years ago. So we've committed about $14 million. And at this point, with that kind of growth, we're currently looking at a volume of around 200 loans a year. You know, not a tiny program, but also, you know, still smaller than, say, some of our grant programs, which are serving a couple thousand homeowners a year. And we've also seen the loan amount, the average loan amount, grow over time. So it's now around $40,000, which comes to a monthly payment amount of $400. Homeowners have the first year to draw down the loan, do repairs, and then they repay over the next 9. That said, we do see that average again has grown, but there is a pretty wide distribution. So there are plenty of homeowners that take out a $10,000 loan, and again we see you know, some of that reflects the income distribution, because you know, a lot of folks are understandably very reticent to take on more debt, and they might have a very narrow scope of work that they're looking to do, and this program also can accommodate small loans of, you know, say $10,000, $12,000. Go to the next slide. And I think the piece that I really want to emphasize here is that this product, you know, again, now with about 5 years under our belts, we're able to see that it really is reversing some of those inequities that we see through the HMDA data. If we can go back one, sorry, I apologize that it looks like somehow there are transitions built in here. I don't know how that happened. So and we're seeing that reversal while still maintaining a really low delinquency rate of well under 3% throughout the program. The average borrower income is around $60,000. So that's, again, depends on the household size, but we tend to see that's around kind of 65 to 70% of area median income. The debt to income ratios on the back end are just around 34%, and that's remained pretty stable. The interesting thing is that while we do allow a kind of minimum credit score of 580, most folks coming through the program actually have great credit. And I think what I'll talk about a little bit more is that often we have, not always, but a common use case is that we have seniors with great credit who are on kind of fixed income, and so it's really some of the other things besides credit that might be barriers in the traditional market. So you can see here on the right that credit score distribution, very, very, very few people kind of needing that 580 to 600 credit score flexibility. Most people are between 700 and 800. Go to the next slide. So right now, we are seeing, kind of denial rates or folks kind of being found ineligible around 35%. So it's not that the program can serve everyone, but again, we are seeing a kind of lower bar compared to those denial rates of say 70% that we would see through the national data. We can go back. And really the main challenge there is still debt to income. And you can see that that's kind of the main reason that folks continue to be denied. Sometimes it'll be the LTV again, especially for folks who are more recent home buyers, but it's largely DTI, and most often, as you can see here on the right, apologies for all the graphs, that's largely due to income rather than debt. We see people who are closing loans versus their counterparts who are being denied or withdrawing, very similar kind of monthly debt profiles. But the places that we see more of a discrepancy is around income. And I think that speaks to really deep and ongoing challenges that we have in Philadelphia with low wages and salaries, and that being really a continued barrier. Actually, if we can go back, I think 2 slides, I think we might have missed one. Here we go. Great. I just wanted
This
to.
slide deck, by the way, is advancing itself for some reason. So Anne's in the background trying to go back.
Yes, thank you so much, Anne. I apologize. I had no idea that there were transitions built in. So thank you for working with me on this. So here's a map of Philadelphia. It will mean something to the folks on the call from Philly and not much to anyone else. But we do see that this loan product is working really well in those middle neighborhoods. So in parts of West Philadelphia, as well as the Northwest and Upper North. These are, again, not the neighborhoods with the lowest incomes, but again, really at that kind of 60 to 80% of area median income, that range. And what we're seeing in terms of folks who close loans, it's about 2/3 Black borrowers, about 20% white borrowers, 2% Asian, which is a real underrepresentation of Asian households, and about 17% that are not reporting. It's also Hispanic residents are also slightly underrepresented in the program at just 7%. And in terms of gender, it's overwhelmingly women who are closing our loans, with just over 70% of borrowers identifying as female. We do have some situations with, we do see a number of loans that have co-borrowers, but that's not super common. Generally, we see just a single borrower. The other thing I want to flag is that the average borrower age is 55. So this is absolutely serving, not exclusively, but largely longtime homeowners who have been in their home for a long time and are themselves older. Okay, we can jump back, I think, 2 or 3 slides. One more, great. So as I mentioned, the product is meant to be really flexible, unlike our grant programs, which have a much narrower scope. This is, restore, repair, renew is really broad. And so we most often see people doing kitchen repairs, things like doors and windows, bathroom upgrades. And again, these are things that the grant programs can't accommodate. We can go back one more Thank you. We also see a lot of roof work and HVAC work, which is great. Again, that's both kind of adding, doing upgrades to more efficient systems, potentially adding cooling in a lot of cases, which is really important as our summers get hotter. And those roof repairs really preventing leaks and other things that can dramatically damage a home. Okay, we can go forward. And something that we've learned more recently as we've done more robust program evaluation is that when we survey homeowners, 6 months after they've finished repairs, so they have, again, a year to draw down the loan and do repairs. So if we talk to them 6 months after that, we see that most people are reporting back one more, some sort of improvement to their health and wellness. We have like 75% of the folks that we surveyed reporting improvements to their emotional health, about the same, reporting improvements to their feeling of safety and physical health, as well as things like their comfort indoors in the summer, their ability to host friends and family, as well as kind of safety moving around the house, although that's a little bit less common. So I think this really speaks to just the power of home repair to influence a really wide range of aspects of health and well-being, and again, the kind of broader return on investment that this city is getting through this program. Not only are we recouping the loan principal, because it's being repaid at that 3%, but we are also most likely seeing improvements in things that other ways that people are interacting with the city, whether that's through their use of other services, code enforcement, a variety of things, their use of health services. We think that this program is making improvements in those areas as well. You can go to the last slide. So I spoke at the top about the importance of partnerships here. So again, PHDC absolutely could not do this program on our own. Really so grateful for our partners at Clarify, who are doing intake and housing counseling with clients. They're doing an initial eligibility screening, helping people gather documents, and prepare for that loan application at the bank. And then we have really great partners at Univest and Fulton Banks. These are two regional banks in the Philadelphia metro area who are doing that origination using those manual underwriting criteria that we have to originate the loans. And then the city buys back the loans after the first year, but the original lenders continue to service them. Again, we think this is a really successful program. Looking forward to closing our 500th loan soon. That said, there are some ongoing challenges. I'm happy to take questions about these or hear how this has worked in other places. So here in Philly, it continues to be a challenge for homeowners to find and manage reliable contractors. So we see folks struggling to get bids or having bids that are kind of priced reasonably, or problems with the quality of the work. That's a problem here, as it is, I think, in many places. Another issue that we see is that, again, for some of these older homes that might have certain areas of disrepair, they might have a really tough time getting and maintaining a homeowner's insurance policy. And again, that's a requirement for the loan. And there's just really limited options for people who aren't able to get homeowners insurance. And so that's something we've continued to kind of work on, but haven't found a great solution yet. Another issue in Philadelphia is tangled title or heirs property. Again, we require the borrower to be able to sign a mortgage, so they have to have clear title, but there are many people who inherit a property or are somehow navigating unclear title that currently RR doesn't have the best way to serve. We also see people with private judgments or things in collections that they have to pay off prior to loan closing. Sometimes that's they're stale and it's not a huge deal. Sometimes they're large enough that people really struggle to do that. Again, we can't serve folks until those are paid off, or for municipal loans in a payment arrangement. The other thing that I think is interesting is that we have a lot of folks kind of taking themselves out of the process because they perceive before getting through the full intake process that their credit score might be too low, or that for some other reason they're not going to qualify. And so we're also working on ways to kind of keep folks in the process long enough that they can see that actually it might be a good fit, rather than people getting scared off because they're worried about their own credit, or are not sure that they would be able to afford a payment before they even know exactly what the payment would be. This is also a really hands-on program. So for folks who, have great credit and are in a solid financial position, they could walk into a bank and get a home equity loan much faster than this program. We have around a kind of 60-day timeline from when someone calls Clarify to when they close a loan. And so for certain people that might have options on the private market, that's just a longer timeline. So we've worked hard to kind of condense our turnaround times as much as possible. But again, there's aspects of this loan, like some of that hands-on support and counseling and a home assessment, that we think add a lot of value, but the trade-off is that they make it a little bit longer. And I will end there and happy to take questions.
Thank you so much, Rachel. My memories of this program, and you can correct me if I have the years off a little bit, but the current new mayor of Philadelphia, I think at the time this program was getting created, was a city councilwoman, and was very, I'm pointing this out because it has so much to do with middle neighborhoods in particular. A lot of her district, as I understand it, is in that area where a lot of those loans were made, right? And she really sees, she's quite a champion of middle neighborhoods and always has been. And particularly because she has had in her district a lot of Black middle neighborhoods. So middle neighborhoods with older homeowners who needed repairs on their homes. And I think that some of, for instance, why the uses of the loan proceeds are a little more flexible is because, the goal isn't just about getting an individual homeowner into, code compliance. It's about preserving whole neighborhoods worth of middle range housing stock and getting it started to be updated for the next generation. I'm putting words in who knows how many people's mouths, but I think this concept of, that is always one that's top of mind, I think, for middle neighborhood practitioners, is that we have so much housing stock in this country. I think the average age of a home now is 41 years across the nation, or is a median home age or something. I read that at Joint Center for Housing Studies. And so we have a lot of housing stock that needs to be updated and repaired, and we have so few mechanisms for doing that. So this is really stunning. And what would you say? I was just looking up what interest rates are on a home equity.
Yeah, I think they vary, but and I'm not an expert here, so if anyone wants to jump into the chat, but my understanding, at least for some of the investment properties, is that they're well above 6%.
Yeah, that's what I was thinking. So yours are always bought down to 3.
Yep. Yeah. And again, I mean, like Elliot said, we were in a different position a couple of years ago when on the private market, people could get a loan at, close to, or in some cases, even less than 3%. But we see the program as, significantly more competitive now that rates are so much higher.
And what would be, do you have a sense of the home value of the properties that you've been lending for?
Yeah, it's a range. Let's see, I could pull it, my guess is that it's in the, kind of most likely in the 175 to 275 range.
Mm-hmm. I'm at Rocket Mortgage right now trying to, but they ask you 1,000 questions. I guess I won't get there. So we'll just take it that it's in the 6+% range, which is comparable to a first mortgage, actually. So that's kind of surprising. Back when I used to think about rehab loans, I thought they were more, always at a higher cost than the original first mortgage. But let's take some questions. We have a few in the Q&A that were that were great questions. Just could we do another rundown of how each of you funds the interest rate buy down portion of your programs? So Candy, yours is CDBG or something, right?
It is, it's CDDBG. Yep.
Okay. Elliot?
Ours are local funds through the city of Boston, and they're combination of CPA, Community Preservation Act, and ARPA funds.
And ARPA funds right now, yeah. So, okay, and
That's just, ARPA is just temporary until those are
Yeah.
gone. CPA is
So
more
who knows?
long standing.
And then Rachel, yours is a bond issue, did you say?
Yeah, it's local funding as well through a bond issuance.
Okay. So that's the answer to that question. And how many of you can go past 80 up to 120? Elliot can, right?
100.
100. Rachel,
You go up to 120.
120?
Mhm.
Yeah. And Candy, you're just up to 80
Just 80,
right
yes.
now? Okay. And then the next question was, when the interest rate is bought down, is this for the life of the loan or just for a period at the beginning? But it's for the life of the loan, right? In all cases, yeah. And then related to that, if the interest rate is brought down at purchase, but then the buyer needs a modification, is the buy down factored into the modification, or do they reset to the prevailing rate with their modification?
Ours would be based off the bought down rate, but any modification is going to be handled primarily between the borrower and the first mortgage lender. And we,
Yeah, so yours is always a second, so yeah. Okay, I hope that helped with answer those questions. And then over here, we had a person early on in Rachel's presentation ask about why folks were getting denied by traditional lenders for a home equity product. I think you kind of answered that, but how would you summarize that?
Yeah, I'll drop the link if I can pull it up quick enough to the work that the Federal Reserve Bank of Philadelphia has done. My recollection is that it's I think credit is the kind of most common reason, and then DTI is the second, and LTV is a kind of distant third.
Mm-hmm. And if the cost of the loan is more, then that's going to make it harder to qualify. Are there any local requirements of the sellers regarding their responsibility to correct repairs or leave funds in escrow for the new homeowner? So Lori, do you mean that actually, can you unmute yourself maybe and ask that question? Lori Sanford. Like, are you asking if a person could get one of these loans and then just not complete the repairs? Or is somebody checking up on that? And I guess maybe the implication here about leaving funds in escrow for the new homeowner, could that be, you're not making loans to developers, right? Rachel?
No, and in general, I think a positive thing is that, we do see some payoffs and, where we're doing satisfactions because of sale, but by and large, people are getting these repair loans because they want to stay in their home, not because they're looking to turn around and sell.
Interesting, really interesting. And by the way, I can't add because I'm so fascinated by it. It's so a little bit related to that. It's not developers, it's landlords, but we were talking before the webinar started that Rachel also has a really interesting landlord home repair loan program that goes up to $25,000 a unit, right? Something like that. And it seems to be going gangbusters. So there, that's just to acknowledge that there are other needs out there for lending around repairs. And for sure, if you have developers, if you have a robust kind of acquisition, rehab, resale market, again, in the spirit of getting our middle neighborhood housing updated, I'm generally all for helping to incentivize developers to do a good job with that. Because we have just a massive need for that kind of rehab. So, anybody else have any questions? I think we've answered these three. Let's make sure I got them all. I think so. Okay. Well, let's see. Was there another question I had? I am kind of, I guess, curious for each of you to look into the future and like, are you just going to reevaluate your programs once a year? I know it's a little bit different for you, Rachel, aside of kind of maybe, I mean, the need that you're feeling, I feel like is permanent for sure, is more obviously permanent, no matter what happens with interest rates at the national level. They're never going to be as low as probably what you're offering for for home equity, home improvement loan. But Candy and Elliot, like, is it just a limit of funding? Candy, what does your city government say to you about how long they might be willing to do this?
Well, we and the city have been struggling. So the city has a bucket of money that's not been used in a little bit. So we're going to use that at 15,000 this year and probably next, because that was part of the consolidated plan option. So we're just going to kind of base it on, hopefully interest rates will come down. There'll be a bigger buy down options and try to spend that money and get homeowners.
And Elliot, I think you said something about you see that you're starting to see this as a permanent
In conceptually,
need.
right? Yeah, I mean, as long as there's money for it, we
Yeah.
at the end of this year did agree with the city to sort of take stock of what the need is, whether or not we can afford to continue offering that 200 basis point level buy down, because that is costly, that's really the big thing. It's that balance between serving more home buyers and serving the ones that we do serve with enough, so
Yes.
just trying to
Yeah.
find the right middle ground there. But we have no plans to not offer this program in the years ahead.
I mean, I wonder, maybe it's obvious to all of you, but I'm starting to wonder the way that you describe that, Elliot, whether it's just going to become another way that we try to deal with the affordable housing crisis in this country. I mean, housing prices don't seem like they're going to go down anytime soon, and we have to tinker with something, right?
Right, and this is a much easier way. So we're short like 40,000 housing units in Massachusetts or something like that, right? And those don't just happen overnight. It's going to take years and years for the stock to catch up, and even then, there's no guarantee that the stock catching up will mean that prices, right, like
That's right.
flatten. So this is the tool we have right now to help. Always wish we had more, but yeah, for that reason, I think this, again, conceptually should stay. And we'll continue to find, hopefully the city CPA funds continue to be generous. But if those become fewer and fewer, we're going to seek alternative funding sources.
So Duffy put in, what kinds of credentials are needed to start and run these types of programs? I mean, my answer to that would be, obviously it still is a loan program, so somebody has to be doing the lending and it has to qualify in whatever way that happens. So depending on the situation, I mean, I think Candy is basically completely running this or is it totally a grant, Candy, in your case?
Basically, we do the homebuyer education and produce home buyers, and then the city and local lenders send people to us for homebuyer education, and then we partner with the city. We do the education, goes back to them for the loan as long as they income qualify, then they're eligible. So.
Okay, so is the city underwriting a second mortgage?
They
To
are.
secure that grant? Okay, and then
You're forgivable. So
the other lenders doing the first mortgage. So I think everybody here is partnering with lenders to do the underwriting. It's just a matter of what kind of organization you need to be to Elliot's case, organize the lenders or, provide the support that Candy provides, which is not unusual for nonprofits in a relationship with lenders to take on that homebuyer education and counseling, and sometimes even do take applications and stuff like that. Elliot, your organization may do more. Do you do more of the underwriting or not?
We do sort of we do a compliance underwrite, right? To make sure
Okay.
that they qualify for the program based on our terms, but the affordability, the underwrite of the loan itself is done at the bank. So like our credentials, it's really, it's relationships. It's strong working relationships with the lender community and with the nonprofit home buyer education community that make this happen.
Yeah. So if you have been in community development, but you've never been on the sort of lending side of community development, it's a whole side to things. There's an arm of community development that focuses on real estate development as their main tool. There's definitely an arm that focuses on loan products as their main tool. And so if you needed to find an organization that was in that arm of community development, you might look for a CDFI that serves your city or state, because a community development financial institution, they're absolutely going to be in the business of doing lending themselves and also probably partnering with other lenders, conventional lenders, to get capital out there. Your state housing finance agency might be a place that you could get pointed in the right direction. If you're like advocating for this kind of product to be offered in your community, you might look at local government and see what kinds of stuff they already do. Look for a CDFI that serves your city or state, and look at your HFA, your housing finance agency, and see what they're doing. And maybe even, I mean, I was going to say major lenders look at what their community development offerings are. Although, for instance, Rachel, you don't have big national banks, you have local regional lenders. And that's not unusual too. If it's a kind of funky loan to have, they're a little more flexible. And Elliot, are yours, what's kind of the type of lender in your pool?
Yeah, mostly smaller to mid-sized Massachusetts banks. Our biggest bank, though, Citizens Bank, and they're, of course, a big regional bank. But yeah, mostly small to medium size, and even like really small credit unions join our program.
Yeah,
And,
credit unions are great. So it's not Bank of America and Wells Fargo. It's,
correct.
Our
largest lenders historically, were Bank of America or, Fleet, Bank Boston, like Legacy.
Oh yeah.
And Santander, but they've all sort of slowly over the years pulled out of the program as they've pursued their own products and things. And so we're
I see.
operating now with a sort of tighter, like local lender base.
That's I keep trying to draw a direct connection between the extent to which smaller regional or local community bank and their willingness to do unusual loan products, but people tell me there really isn't a direct connection. But I see it so many times, like they're willing or able to keep some stuff in portfolio for a while until it can be sold, and they just can, they're just a little more flexible. So those are some places that you might start, Duffy, to sort of figure out who's doing what already, and then start to advocate with them around doing some interest rate buy down stuff. So Anne, do you want to give me my closeout slides? This was such a fascinating panel, and you guys, I just think it's really so important that more and more people hear about what you guys are doing, because surprisingly, like Candy said, there people don't even know that this is a thing, right? Candy, you have to be old enough, like Candy and I hope I'm not insulting you by comparing your age to mine, but to remember the last time that this was an issue and people did this. So it's absolutely a tool. It's absolutely something that apparently even HUD can approve. It's something that lenders understand. It's something that any regular home buyer can do when they're negotiating their mortgage, is buy down the interest rate. It's just a matter of where they get the cash. So our next webinar is going to be about landlord training programs. So all of our middle neighborhoods have rental property in them. And particularly there still seems to be a fair amount of the small independent landlords owning that property. Also, we've noticed that there is you know, increasingly as people try to protect and nurture the passing of intergenerational wealth in families, that it is not unusual for a family property and heir property, for once you work out all the problems and getting the title in the right place and all that, for the family to want to keep that property in the family, but they want to rent it out. And so normally, I think most of us, our headsets about, oh, let's get rid of, you know, as many landlords as we can. But in this case, I think there's a goal, another goal at stake. So just the idea of how can we make the landlords that we have in our middle neighborhoods the best landlords they can be. And so we're going to give some examples of some really interesting landlord training programs. And we have another engagement chat coming up on October 16th. This one's going to be about conflict management in neighborhoods or a group agreements. I don't know what tree felling is and does this. But this is usually a robust discussion for anyone who's sort of engaged on the community engagement side of things. If you have any questions about any of that stuff, email Anne. We love having your requests. Oh, it's cooperative tree cutting. Okay. We love having your requests for webinar topics. So please email all of us. Marcia, MARCIA at middleneighborhoods.org is where you can get me easily. Our friendly partner, Center for Community Progress, also does a webinar series that's terrific. It's Cornerstone webinar series. Check them out. And you'll get an evaluation from us where you can list your ideas for future webinars and tell us about your experience. So thanks again to all four or three of our panelists. They were absolutely fantastic. I feel like I know so much more about this topic, and I really feel, particularly the new thing that happened for me, I think, was this idea, Elliot, that this isn't a temporary thing. The way housing in this country is now, we need to start advocating this to be a permanent thing. So join us in our Middle Neighborhoods community practice, and we'll see everybody next month.